If you look at the national economy, it has been on a recovery track for the last almost 2 years now. Much of that economic recovery is still a little shaky because some of the projections made about the economic GDP growth rate has not really materialized. So if you look at the national GDP, it's still growing at a fairly weak 1.8, 1.9% year over year. And that's a much lower figure compared to the 3.8%, 3.9% that had been projected early on. So if you look at our economy, we are still looking for a floor in the real estate market. We haven't found one. Residential real estate is still sinking to a large extent. Of course, depending on location, as they say in real estate, location, location, location. So there are some communities that are dropping less steeply compared to others, but the residential values are still going down. And there are pockets, even within the residential real estate market, that seem to be stronger than other pockets. So for example, if you look at the low-end housing market, certainly that end of the housing market seems to be bouncing back because the affordability aspect of Sacramento has finally kicked back in. And people are now once again looking at homes costing maybe about $100,000, and that segment of the market is extremely attractive to investors. I think the key to the Sacramento region is jobs. It's all about jobs, jobs, jobs. We don't have any new jobs coming into the region, and the existing jobs are either compressing or basically slowly diminishing in size. If you look at the private sector, I think even the healthcare sector for a while came under pressure, even though the healthcare sector and the education sector are typically considered to be economically recession resistant. But I think in this recession being the deepest and the longest on record since the Great Depression era, we can clearly see that even these two sectors have come under pressure. Even the national economy, even though it's coming back and it's growing and it's still positive, I think there are many people who are very, very afraid right now of a double dip recession, because when you look at a 1.8, 1.9% GDP growth rate year over year, that could very quickly become negative. And right now, given that corporate America, even though they have a lot of cash sitting on the balance sheets, but the cash is still on the sidelines. It's not being reinvested in any meaningful fashion back into the market or back into the economy. I personally don't believe that we're going to basically be seeing a double dip recession. However, the probability of us having a double dip recession remains on the table. And it doesn't take very long for some of these positive economic indicators to become negative pretty soon. Could my opinion change about the fact whether or not we're going to see a double dip recession? Absolutely. A few months ago, I was absolutely 100% certain that we would not be seeing a double dip recession. I don't think I'm 100% certain at this point. I'm very encouraged by what I'm seeing in terms of the signs and the economic indicators nationally. Worldwide, I think we still have some work to do because there are many economies that still have not solved the debt problem. Locally and regionally, I'm a little bit less optimistic because I think the name of the game is jobs. This is not only the capital of the state of California, but also a great, great community to raise a family and live in and enjoy the natural resources and everything that Sacramento has to offer. So while there are a lot of things that look extremely weak and negative right now in Sacramento, I'm hoping that this too shall pass and that we will find ways to move on and that we'll find some strength going forward.